Welcome to Breaking News to Trading Moves. I am your host, and today we are looking at a specific set of movements in the market. It is all centered around one company, but it is really affecting a much wider ecosystem.
Yeah,
We are talking about Flutter Entertainment.
right, Flutter. And, I mean, most people probably know them as the parent company of FanDuel.
Yeah,
The ticker symbol for them is FLUT.
exactly. And usually when we talk about these companies, we are looking at how many people are placing bets, who is winning the big games, what the revenue looks like right now.
Yeah, the immediate numbers.
Right, the immediate numbers. But the news that came out recently is a little more nuanced. It is about guidance, specifically Flutter's financial guidance update.
It is a classic case of the market reacting not to what just happened, but to what management says is going to happen next. It is all forward-looking.
So let's look at the headline. Flutter released their numbers. How did 2025 look?
Well, 2025 actually looked quite strong. The profit growth was absolutely there. I mean, if you were just looking in the rearview mirror, you might think everything was just full steam ahead. They delivered on the profit growth that investors really like to see.
But the stock market is a forward-looking machine. It cares about tomorrow, not yesterday. And that is where the snag hit, right?
Precisely. The issue arose with the guidance for 2026. Management came out and, well, they guided to core profit growth that was much slower than what Wall Street estimates had penciled in.
Right.
And when you have a growth stock or a leader in a growth sector like online sports betting, a deceleration in projected profit growth just makes investors pause.
Okay, let's stop there for a second. We hear this term guidance all the time. Companies guide up, they guide down. Why is this specific 2026 number causing such a fuss if the company is, currently profitable? It feels like investors are being incredibly picky.
It is not just about being ticky, it is about valuation models. Think about how a stock price is calculated at its core. It is effectively the present value of all the future cash flow that company is going to generate.
Discounted back.
Exactly, discounted back to today. So if you suddenly say, hey, in 2026, we are going to make 10% less than you thought, you aren't just changing one year's number.
You change the whole curve.
You are changing the trajectory for every single year after that.
Because the growth curve flattens out.
Exactly. The angle of the line changes. And when that angle flattens, the actual price people are willing to pay for $1 of earnings, it contracts. So the stock gets hit twice.
Once on the earnings and once on the multiple.
Right. Once because the earnings are lower, and twice because people want to pay less for those remaining earnings.
That makes a lot of sense. It is the difference between a rocket ship and a commercial airliner. Both fly, but you pay a premium for the rocket.
Yeah, that is a great way to put it.
So they are saying 2026 isn't going to be as hot as everyone thought, but we need to understand the why. Companies don't just lower guidance for no reason. What were the specific factors they cited in this update?
They laid out a few distinct reasons. The first one, and perhaps the one we need to break down the most, is that customer engagement in the U.S. is cooling down.
Cooling down. That is a phrase that makes traders nervous. I mean, we have spent years hearing about the explosive growth of sports betting in the U.S. You see the commercials every 5 minutes.
You really do.
Yeah.
And cooling implies that the frenetic pace of acquiring new users and getting them to bet constantly, it might be normalizing.
Right.
It is not necessarily crashing, but it isn't that straight line up that people might have extrapolated forever into the future.
Let's examine that. What does cooling engagement actually look like on the ground? Are people just bored of betting, or is this an economic thing?
It is likely a combination of economics and the novelty wearing off. Think about the last 3 or 4 years. We had the post-pandemic boom, we had stimulus money in the system, and we had these companies, FanDuel, DraftKings, just engaging in an all-out land grab.
Yeah, they were giving away money.
They were.
The risk-free bets, deposit $100, get $100.
Exactly. That is a straight subsidy. And when you subsidize an activity, you get more of it. People were betting with house money. Now the companies are transitioning from growth at all costs to profitability.
Because Wall Street is demanding it.
Right. Wall Street wants to see the cash. That means fewer subsidies, fewer free bets.
So the training wheels are coming off.
And when you take the free money away, you find out what the real organic demand is. It turns out, when the average U.S. consumer has to bet their own rent money or grocery money, and inflation is still a factor in their daily lives, they might bet a little less.
So we are seeing the difference between a bonus hunter and a loyal customer.
Correct. The churn rate, the rate at which people stop playing, might be higher than the internal models predicted, If a guy blows his bankroll in week 4 of the NFL season and doesn't reload because he doesn't have a free bonus waiting for him, that is a structural engagement problem for the operator.
That is a fascinating transition in the narrative. It is not just that everyone loves betting, it is that everyone loved subsidized betting. What else? I know outcomes play a big role in this business.
They do. Management specifically mentioned a stretch of favorable sports results.
Now, for those who aren't in the weeds of gambling terminology, favorable sports results sounds like a good thing, like my team won.
Right. Favorable for the better, perhaps. But for the sports book, favorable results usually means the favorites won. The public tends to bet on the favorites.
Wait, hold on. I have always been told the house always wins. How is it possible for a casino to lose money just because the favorites won? Don't they have algorithms and math to prevent that?
The house edge works over the long term and over millions of bets. But in the short term, they have liability. Imagine a scale. On one side, you have the public betting heavily on the Kansas City Chiefs because they are the popular team.
Right.
On the other side, the bookie needs people betting on the underdog to balance that scale.
So the money from the losers pays the winners.
Ideally, that is how they make their commission, or the VIG. But if 80% of the money is on the Chiefs and the Chiefs win, the bookie doesn't have enough money from the 20% of losers to pay out the 80% of winners. They have to pay out of their own pocket.
That is the hold percentage I hear analysts talk about.
Exactly. The hold is the percentage of money bet that the casino actually keeps as revenue. When the favorites win, when the popular teams cover the spread, the hold percentage drops. It might even go negative on a specific Sunday. So a stretch where the public wins a lot is actually a headwind for the company's bottom line.
The house doesn't always win, apparently. Or at least they don't win as much as they forecasted in a specific quarter.
Exactly. And tied to that, they noted a softer finish to the NFL season. The NFL is the absolute kingmaker in U.S. sports betting. It is the highest volume sport by far. If the volume or the margins dip at the end of the NFL season, it really moves the needle for the whole year.
And there was one more factor they listed, which seems a bit more internal. Execution issues.
Yes. Regarding the execution of promotions and bonuses. This is the nuts and bolts of how they get you to bet. If they aren't deploying those promotions effectively, or if the bonuses aren't driving the return on investment they expect, that is an efficiency problem.
Explain that ROI on a bonus. If they give me $10, what do they actually expect back?
They expect that $10 to generate, say, $50 of betting volume over the next month, which eventually turns into $5 of profit for them. They have very sophisticated models for lifetime value, or LTV.
Okay.
If they spend that $10 and you just bet it once and leave, or if the promotion doesn't even get you to log in, that is wasted spend. It means their marketing machine is sputtering.
So we have a cooling market because the thug cities are drying up, bad luck with sports outcomes because the favorites kept winning, and some internal hiccups on making their promos work. That explains the base guidance miss. But there's another layer here, a strategic cost.
This is where the story pivots from just bad luck to new strategy. There is an additional factor pressuring those 2026 profits, and that is a planned increase in spending. But they aren't just spending on more ads for the Super Bowl. They are spending on an entirely new product category.
We're talking about the partnership with CME Group.
Correct. Flutter is working with the CME Group on a prediction markets product.
Prediction markets. That feels different from just betting on who wins the Lakers game.
It is very different. It moves the conversation much closer to financial trading. And building that product, integrating with an exchange like CME, it takes capital. It takes serious investment. So part of that lower profit guidance for 2026 is actually a conscious choice to spend money now to build this new capability.
Which brings us to the sector implications. Why does the broader market care so much about one company's guidance?
Because Flutter is the bellwether. They are the category leader with FanDuel. They have the most data, the most users, and the best view of the landscape. When the leader catches a cold, the rest of the sector checks its temperature.
It suggests this isn't just a Flutter problem.
Exactly. If FanDuel is seeing lower engagement, it serves as a read-through for everyone else. It implies that maybe the U.S. consumer is a little tapped out on betting across the board.
And if engagement is lower, what do companies usually do?
They fight for the remaining customers.
Which means spending more money.
Right. If the leader has to spend more to defend its market share, it implies a more competitive environment overall. It implies that margins across the entire sector could be squeezed because everyone has to pay more to keep the customers they already have. It creates a race to the bottom on profitability.
And then there is this move toward prediction markets you mentioned.
That is the structural change. It highlights that prediction markets are emerging as a real alternative to traditional betting. And there is a legal nuance here that is vital. Prediction markets are attracting users even in states where traditional sports betting remains illegal.
So it is a way to expand the map, essentially.
It creates a new avenue for participation. But it also blurs the line between gambling and trading, which is a theme we will see impacting the winners and losers today.
Let's get into those winners and losers. We have categorized these by sector to keep it organized. Let's start with the winners. And the first category is what you might call the plumbing.
Yes. Category 1 is exchanges and infrastructure.
The concept here is pretty straightforward. If prediction markets grow, the underlying infrastructure that supports them benefits.
It is the picks and shovels thesis. You don't have to bet on which team wins. You bet on the fact that people will be betting. If prediction markets become a standard way for people to speculate on outcomes, the entities that provide the exchange mechanisms, the clearing, the data, they win.
So who are the specific tickers we are looking at here?
First and foremost, given the partnership we just discussed, is CME Group, ticker CME.
They are the partner in the Flutter deal. But let's pause. CME, that stands for Chicago Mercantile Exchange. These are the guys who trade corn and wheat, right? Why are they involved in sports?
It is a great question. The CME is the historic home of futures trading. They invented the idea that you could trade a contract based on the future price of pork bellies or gold. What they're doing now is applying that exact same logic to events.
So instead of betting on the price of corn in December, I am buying a contract on the Chiefs winning the Super Bowl.
Exactly. And the mechanism is fundamentally different from a sports book. In a sports book, you bet against the house. In exchange, you trade with other people. CME just sits in the middle, matches the buyer and the seller, and takes a small fee.
They are the toll booth.
We are the toll booth and the referee. They handle the clearing, which ensures that the winner actually gets paid. This puts them right at the center of this convergence between betting and trading. But they aren't the only ones. We also have Intercontinental Exchange, ticker ICE.
And Cboe Global Markets, ticker CBOE.
Correct. All of these entities operate exchanges. They thrive on volume. They thrive on new product creation. If event trading becomes a new asset class, where you trade the outcome of an election or an economic number or a sports season just like you trade oil or gold, these are the venues where that trading happens.
And crucially, they don't take directional risk.
That is the key. If the favorite wins, CME doesn't lose money. They make their fee regardless of the outcome. They actually like volatility. They like it when people are unsure because that creates more trading volume.
So while the casinos are sweating the favorable outcomes, the exchanges are just collecting their toll.
Precisely. They are the casino owners, in a metaphorical sense, but regulated as financial exchanges.
Let's look at category 2 of the winners, lottery and gaming suppliers.
This is a bit of a derivative play. The concept is that when operators, the consumer-facing apps like FanDuel, stop spending heavily on promos, they have to focus on something else.
If you can't just give people free money to play, you have to give them a better game.
Exactly. You have to focus on profitability and product. You need sticky content. You need iGaming, which is online slots and table games.
Why iGaming specifically?
Because the margins are better. Sports betting is low margin, maybe a 5 to 7% hold on average. Slots can be much higher. And it is faster. You can spin a slot machine 10 times a minute. A football game takes 3 hours to resolve.
So the companies that make the games and the technology benefit.
Yes, suppliers with a broad footprint. If operators are looking for the best slots to keep people engaged without giving them a bonus, they turn to the big suppliers.
Who are the names here?
International Game Technology is a big one. Ticker IGT. They provide the back end and the content for lotteries and gaming halls globally. They are the engine room.
And then we have some operators that are also suppliers or have diversified tech stacks. DraftKings is mentioned here, ticker DKNG.
DraftKings is in a unique spot. They are a competitor to Flutter, obviously. But they also have their own tech stack and have been pushing into iGaming aggressively. If the market moves toward product-led retention, they have invested heavily there. They acquired Golden Nugget Online Gaming specifically for this reason.
So they aren't just renting the games, they own the studio.
In many cases, yes. And that vertical integration really helps their margins.
And PN Entertainment, ticker PENN.
PN is listed here, but with a caveat. It is highly execution dependent. They have the physical casinos, they have the ESPN-BHA partnership, but their ability to win as a supplier or product innovator depends on how well they integrate their technology. But in theory, owning your own tech stack is an advantage when marketing spend dries up.
Okay, category 3 for the winners. Payments and compliance. This is the unsexy side of the business, but it is essential.
The logistical side, the core concept here is fragmentation.
Explain that.
Well, we have sports betting. Now we have prediction markets. We have different states with different rules. We have some states where you can trade but not bet. This fragmentation increases the complexity of moving money around and verifying who is who.
You need to know if the person is 21, if they're in a legal state, and if the money is clean.
And you need to route the payment to the right bucket. Is it a wager? Is this a trade? Is it going to a segregated account? The regulatory scrutiny on what is gambling versus what is trading drives demand for sophisticated services that can handle that compliance.
So the companies that handle the plumbing of the money and the identity are the winners.
Yes, we are looking at Fiserv, ticker FI.
And Fidelity National Information Services, ticker FIS.
These are the big processors. The more complex the transaction landscape becomes, the more operators need their robust rails to ensure they don't run afoul of regulators.
It is the compliance as a service model.
Exactly. If a regulator comes knocking, you want to be able to point to Fiserv or FIS and say, they handled it. It reduces your liability.
All right, that covers the winners. The infrastructure, the product makers, and the compliance handlers. Now let's talk about the losers. And we have to start with the direct competitors. Category 1. U.S. online sportsbooks.
This is the most direct read-through. If Flutter, the leader, is facing headwinds, the other sportsbooks are likely facing them too.
The concept is contagion.
In a way. The logic is that lower customer engagement isn't just a Flutter problem, it is a consumer problem. And if Flutter is saying we need to spend more to keep these people, that implies the cost to acquire and retain customers is rising across the board.
Let's talk about that cost to acquire with CAC. How does that impact the stock price?
It destroys the unit economics. If you used to pay $200 to get a customer who's worth $500, that is a great business. But if the customer is now only worth $400 because they are betting less, and you have to pay $300 to get them because of competition, your margin just got crushed.
So revenue slows down because people are betting less, but costs go up because you have to fight harder to get them.
A bad combo for margins and valuation. When the leader cuts guidance, investors tend to lower the multiple they are willing to pay for the whole group. We mentioned this earlier. It is multiple compression.
But who gets hit?
Obviously, Flutter itself, ticker FLUT. They're the ones who issued the guidance. But also DraftKings, ticker DKNG. They are the closest peer. If FanDuel is seeing a soft NFL finish, DraftKings likely saw it too. They haven't reported yet, but the market assumes the bad news is coming.
It is guilt by association.
Or guilt by data. The market assumes FanDuel's data is representative of the whole country.
And Penn Entertainment again, ticker PENN.
Yes, specifically regarding their ESPN BT Bentech. If the market is cooling, it makes it harder for a challenger brand to gain share without burning a tremendous amount of cash. ESPN BT is trying to catch up to the big two. If the big two are struggling to grow, it is infinitely harder for the number 3 or 4 player to break through.
Category 2 of the losers. Casino operators.
This refers to the physical casino operators who have meaningful online sportsbook exposure.
Companies like MGM and Caesars.
Right. MGM Resorts, ticker MGM, and Caesars Entertainment, ticker CZR.
What is the logic here? Why does a digital slowdown hurt the physical casinos? I would have thought maybe it helps them. If I'm not betting on my phone, maybe I go to the casino.
That is one way to look at it, but the market focuses on the omnichannel thesis. These companies have sold investors on the idea that they can acquire a player online and then cross-sell them into the physical loyalty program.
Yeah.
You bet on the app, you earn points, you come to Vegas for a weekend.
So the app is the top of the funnel.
Exactly. It is a cheap way to find customers for the hotels. But if the online growth gets choppy, or if the users aren't engaging, that funnel into the physical properties gets questioned.
Also, don't they have to spend money to support the online business?
Yes, and that is the other drag. If they have to spend more marketing dollars online just to protect their digital market share, that eats into the overall profitability of the parent company. The online division becomes a cash drain rather than a cash cow.
Category 3. Sports media monetization. This is an angle I hadn't thought about immediately.
It is the media companies that rely on ad spend from the sportsbooks.
Ah, so if FanDuel cuts the marketing budget, ESPN sells fewer commercials.
Exactly. Think about how much of the sports media ecosystem is currently funded by gambling ads, pregame shows, halftime reports, podcast sponsorships. It is a massive revenue stream.
And the affiliate model too, right?
Yes, many media sites have links that say bet now. They get paid a bounty when someone clicks and signs up. If the betting operators pull back on promos or get more disciplined with spend, those affiliate payouts drop. The conversion rate drops because there is no free money hook.
So the parts of the media funnel that relied on that aggressive customer acquisition spending start to starve a bit.
That is the logic. So we look at Disney, which owns ESPN to DIS. They recently launched ESPN Bet with PNN, so they are tied into this ecosystem heavily. They have skin in the game now.
And Fox Corporation, ticker FOXA.
Fox has exposure through its option to acquire a stake in the Flutter U.S. business, but also just as a major broadcaster of the NFL. If the sportsbooks aren't spending as furiously to advertise during the games, that pricing power for the 30-second spot softens.
It really shows how interconnected this whole ecosystem is. One guidance update from Dublin, where Flutter is headquartered, sends signals to Las Vegas, New York, and Bristol, Connecticut.
It is all connected. You pull a thread in one part of the market, and the fabric moves everywhere else.
Let's talk about the market movement mechanics. How do these stocks actually trade on this news? Let's start with Flutter, ticker FLUT.
Flutter trades primarily on U.S. growth and margin expectations. That is the engine. The U.K. and Australian businesses are stable, but the U.S. is the growth engine. When the message changes to "we have to spend more to defend our share," the market typically compresses the near-term trading multiple.
Investors pay less for a dollar of earnings if they think those earnings are getting harder to achieve.
Correct. They view the quality of the earnings as lower because they require more capital investment to generate.
And for the challengers, DraftKings, DKNG, and PENN,
They face read-through risk. The market assumes that if the best-in-class operator is seeing a slowdown, the others are not immune. It is rare for the leader to struggle while the number 2 and 3 players surge, unless there is a specific reason like a technology failure. So they often trade down in sympathy.
Basically, shoot first, ask questions later.
Sell the sector, figure out the details later. That is often the institutional reaction.
And then there's the upside angle we discussed with CME Group, ticker CME.
The mechanics there are driven by attention and narrative. The more people talk about prediction markets as a strategy to save growth, the more valuable the CME franchise becomes. It keeps event-linked products in the conversation.
Even if adoption is uneven.
Yes. Even if it takes years to roll out state by state, the narrative changes in their favor. It moves from a niche financial product to a potential consumer mass market product. That expands their total addressable market, or TAM, in the eyes of investors.
So, bringing it all together, we have a cooling sports betting market, a rise in the cost to compete, and a potential pivot toward prediction markets as the next frontier.
That sums it up. The easy growth phase, the land grab phase fueled by free money, might be over. Now we are entering the phase of product differentiation, operational efficiency, and financialization of the sector.
It raises a big question about the future of how we interact with sports and news.
It does. If we connect this to the bigger picture, the rise of prediction markets as a real alternative suggests that users are looking for more than just entertainment. They're looking for a marketplace.
A marketplace of outcomes, where you don't just watch the news, you trade it.
Exactly. And that is a fundamental transition in user behavior. It turns every news event, every game, every election into a tradable asset. It is something to keep an eye on as these platforms evolve. If you are sitting at home watching a game, you might not just be a spectator anymore. You are a market participant.
That is a compelling thought to leave you with. How much of our daily entertainment will eventually just become another asset class to trade? Well, that is all the time we have for this breakdown of the Flutter news and its market impact. We covered the winners, the losers, and the mechanics.
A fascinating setup for 2026.
Indeed. Thank you for listening to Breaking News to Trading Moves. As always, we have to leave you with the disclaimer.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Thanks for listening. We will see you next time.